Okay, good morning then. So, Thursday, 14th of July, important date. Midday is your timestamp. Bank of England deliver their kind of first decision on monetary policy since Brexit. So, as we speak, about 100 metres from where I'm sat, we've got the MPC locked behind a closed door in their first monetary policy meeting, the first official full-on meeting since that vote, 23rd of June. So, really important day, and markets pricing in a cut. Economists a bit more mixed, so I'm going to talk about this. This will be the main sort of content in the briefing. But before we get to that, let's just have a look at the charts. Another bullish day. I mean, what a start here for stocks as they ramp up to extend this sort of post-Brexit rally. This phenomenal rally. We've had the DAX break up forcefully through 10,000 this morning and launching up almost 10,100. We're pulling back with support now at R1. Euro stocks following suit, of course. The S&P's up through that top that we had back on yesterday afternoon, just before the US Open. Lifting up. The high we've got now is up to 2161. So 2200 really is the kind of... This is all-time highs. If I move to a daily chart here, so the S&P chart's bottom left, all-time highs, of course. Let's go to a weekly chart, actually. So the problem with all-time highs is you've got no reference points. We've never traded these prices, so there are no historical reference points in terms of when was the last time we were here and how did the market behave. So the previous all-time high was back here May 2015, 2134. Obviously that's been taken out in style now, and on the upside 2200 is the next kind of let's say psychological barrier, and the way we're going, we're gonna be there at some point next week. I mean, it's just extraordinary the kind of bullishness we're getting out there amongst this equity space. So this morning, it's difficult to put your finger on it. I'm here supposed to be trying to explain moves, how and why a market's behaving the way they are, but actually sometimes just, I don't know, sentiment, trend, whatever you want to call it, just kind of takes over, whether you agree with it or not. We're in a bullish phase for equities, and whether it's probably I would say it's the likelihood that we're going to get multiple economic stimulus from some of the world's biggest economies. We're shaping up for some kind of big package from Japan. Of course, today we may well get some action, at least markets are expecting some action from the Bank of England. What are the ECB going to do? Is there anything from them? Are we going to see any kind of fiscal response? This is what I want to see. I want to see Japan deliver a fiscal stimulus. Apparently they're gearing up for a 10 trillion yen stimulus package in the form of that's the government fiscal stimulus. Apparently they might be issuing some construction bonds. So I want to see this global stimulus cycle change and take a tilt away from monetary policy stimulus and towards fiscal policy stimulus. So I think markets are kind of beginning to price in this scenario. Japan may well be first. The UK, I reckon, will be second. I don't think we're going to get a package of goodies from Carney today. I think markets are expecting a cut, but I'll talk about why I think they won't cut in a minute. But look, this morning, very bullish. Certainly equities on a march and continuing their trends. So just don't get in the way of this, I would say. I mean, let's bring in the oil chart, because let's just quickly talk about crude. Let me just bring up a 60-minute chart. So if I bring the oil up onto the top right chart, because this bullishness from equities, you've only got to go back. And let me just repost my screenshot there. 1 second. You've only got to go back, I don't know, let's say, well, not even that long, a few weeks even, and it's not so long ago that we had this phenomenal correlation between equities and oil. Oil was the lead. It was absolutely the king of markets. Wherever oil went, others followed. It's just that any kind of correlation is just gone. It's vanished. I mean, oil collapsed almost 5% yesterday. So what do equities do? Well, it just marched through the top. It's extraordinary how things change. If oil had dropped 5%, just go back 1 month even, if oil drops 5%, well, equities come under a huge amount of pressure and sell off as well. But it just seems to have completely reversed. So, amazing move on oil yesterday, considering the data, on the face of it, that's the Department of Energy news. On the face of it, the actual supply, the inventory data wasn't bearish, in my view, given that the API had announced a build in crude stocks the night before. The Department of Energy announced a drawdown. Okay, wasn't as big as the drawdown that some of those DOE forecasts had suggested. But look, big sell-off. One thing you could point to that helped with that move lower was this chart here, which is looking at crude oil production, and the fact that, and you can't really see it on the, let me just zoom in a bit on a 1 year time frame, this little kink, because actually it went up. So we had crude oil production levels going up last week, not by much, and look, we're still at the bottom of the year's sell-off, or not, you shouldn't call it a sell-off, the year's kind of decline. So it's the biggest increase in production we've seen in any week, really, for at least 9 months, if not actually for 12 months. So production levels went up, and ultimately this, I would say, was what led to crude oil prices selling off. It's just that at the same time we had crude oil production going up, which is bearish for price. The inventory data wasn't really bearish, so it was a very tricky one from a trading point of view for sure. In the end, we did get down and we tested that low point we had from the day before. We got down to around 44.50, back up to the pivot resistance as I speak. So yeah, oil, big moves yesterday, and really the kind of main feature of the session. Equities took a breather. We were talking about yesterday, equities in this kind of mood. A bad day for equities these days is flat. Flat's the new down. The S&P finished flat. Okay, but very quickly making up for that this morning, of course. So equities are either moving up or they're moving sideways. The idea equities can move down seems to have been removed from the list of options. It seems that gravity has been switched off. So, certainly this morning's moves show that's still the theme. Right, let's talk about the Bank of England. Who thinks they're going to hike? I mean, this is the question. If you're looking at market pricing, 80% probability of a cut. Sorry, did I say who thinks they're going to hike? Apologies. Nobody thinks they're going to hike. Who thinks they're going to cut? 80%. That's what markets are pricing in, the probability of a rate cut today. Let's look at a very interesting chart. Let me just switch to this chart here. It is the case that the Bank of England is the oldest central bank on the planet. And we have data going back to 1694 for the level of interest rates set by the Bank of England in their history. And as you can see on this chart, we broke the low. It was the case that 2% was the historic ever low for Bank of England rates, and you can see this was the case. We first hit 2% in 1854-ish, and we kind of, obviously volatility here, but 2% was the floor for 100 years. Before then we launched into the crazy times that was the 70s and the 80s, which was remarkable. I guess that was a unique period for rates being ridiculously high. We're now in a unique period where rates are ridiculously low. And of course, we broke the 2% floor and we're at 0.5%, lowest in their 300 plus year history. And we're looking for this to go even lower. So we're expecting, I should say, markets are pricing an 80% chance that this rate gets changed from 0.5% and cut to 0.25%. Okay. Let's look at some charts. Why would the Bank of England cut? Well, here's some charts for you from Bloomberg. This is looking at economic conditions. Is the economic uncertainty of Brexit? Well, firstly, can they measure that uncertainty yet? Can they measure economic damage numerically? And the answer really to that is no. This is probably the best way to gauge it. This is something called the composite PMIs. So this is the combination of the manufacturing and services PMIs. We're looking back over 3 years here, and obviously undisputed downtrend. So actually, even before the Brexit vote, the PMIs were indicating that growth in the UK was slowing. In fact, we already had 2 members of the MPC. Remember, there's 9 members of the Bank of England's Monetary Policy Committee. They each get 1 vote, and the majority wins. So how many of these 9 are going to vote for a cut today? Well, you already had 2 of them, Haldane and Vlega. Were already angling and making dovish noises even before the Brexit vote, and really using statistics like this chart where PMIs are indicating we're getting a slowdown in growth momentum. If we just scroll down, here's some other charts to look at. This is business sentiment now. And as you can see, business sentiment took a nosedive at the end of June. This is post-Brexit. All this stuff is soft data, right? This is asking people their opinion and then computing some kind of index value from people's opinion. The Bank of England will not get any real hard data from the fallout of the Brexit vote until the start of August. That's because they need to, economic data gets measured monthly. Now, the vote on the EU referendum was on the 23rd of June. And so actually, it's July, it's the calendar month of July, where we're going to get a whole set of hard economic measurements that will show the real damage to the UK economy as a result of the outcome of that vote. It's just we won't get that information until the start of August. So all you've got until then is soft data, people's opinion, all right? And this gauge of business sentiment here collapsed to a 4.5-year low as a result of the Brexit risk. More stuff. Here's obviously the British pound and how it's changed in value. Of course, we know about this, a collapse to a 31-year low. We'll talk about the pound and how it might react to this event at midday in a minute. Just scrolling down a couple of other things. The FTSE 350 banks index is still lower. Most of the equity space, the FTSE 100's ramped up. It's well above pre-Brexit highs. The FTSE 250 has pretty much recovered all of its losses. The banks are still suffering, and they're currently 8% down on the Brexit high, and the pre-Brexit high, I should say. So recovered about half of the losses, okay? So just a few charts. Here's the probabilities of Bank of England action. So what are the chances of a rate cut? So you can see that pre-Brexit, we had around about a 10% chance that the Bank of England would cut rates. Obviously, this has just now gone through the roof, given the exit vote or the leave vote, and so we're now up to just above 80%. Now, I've got a controversial opinion here. I think, personally, no cut today. And I think, for 2 reasons, they should not cut. Or actually, I think for 3 reasons. So, reason number 1, this Brexit risk is a 2.5-year risk, at least. All right, this is not a short-term game. This isn't a battle, it's a war. And in a war, generally a pretty good strategy is to not use all your ammunition right at the start, before the big battles really commence. So I think the Bank of England should not pull the trigger, knee-jerk reaction, let's get on with it, until they've got some hard evidence that actually the economy is suffering. That hard evidence won't come until August. The August meeting, and by the way, the August meeting is in 3 weeks. Because of the way the timing of the July meeting, it's the middle of July now. Normally the Bank of England's meeting is the first week of the month, but for I guess, I'm actually not sure why, I guess for Brexit reasons, perhaps they bumped it by 1 week to give them a bit more time. But anyway, here we are mid-July. The next meeting is in 3 weeks. 3 weeks is not going to make any difference in this 2.5-year saga. And in 3 weeks' time, they will have July data. It's their quarterly inflation report. They're going to have things like a Carney press conference. it makes just way more sense to wait 3 weeks, gather more data, then make a decision. It doesn't make any sense in my mind to pull the trigger today, especially when Theresa May is now in office. Short-term political risk has been reduced. Markets have bounced. It's not like we're in panic chaos mode, and if we were, fine, all right, maybe the Bank of England are justified in getting on with some action early doors, but, you know, equities are through the roof. It's kind of amazing. So I would say the Bank of England should use the fact political risk has been reduced because of Theresa May's appointment early. I would say they should use the fact markets are actually pretty calm and nonchalant about this, and they should wait 3 weeks and make a more considered judgment then. That's what I think should happen. Whether I'm right or not, time will tell. I'd be disappointed. You know, if Carney pulls the trigger today, he risks delivering policy without genuine evidence of its need, and he risks emptying the coffers. And I'll go back to the chart I showed you to start with. We're already pretty much at zero. There's not much room here on rates. So just use this very little ammunition you've got left. Use it wisely, would be my advice. So how are markets going to react, and what's going to be the most important things here? Well, let's take a look at sterling versus the dollar. And let me make this chart a bit bigger. Now, you know where we are. We are at 31-year lows. Here's the daily chart showing a collapse. 1 second. Let me just sort this out. So we've seen a collapse of the value of sterling in the face of the economic risk that is us leaving the EU. All right, now here we are. We're still pretty much consolidating that move. We had a big move higher on Tuesday, and we're kind of just chopping around now, and we're trading right now pretty much the price point we bottomed out at on the Friday the 24th. Okay. Now I'm going to zoom into a 1 hour chart here. What's going to happen today? At midday, we're going to get a bunch of information. Number one, and most importantly, are they going to cut rates? Yes or no? So, you know, this is quite important, obviously, that piece of information. 80% chance of a cut, 20% chance of no cut. I mean, I think it's going to be no cut. If I'm right, well, sterling's going to rally off that because we're pricing a cut. So if there isn't one, the value of sterling is going to go up. But how far will it go up, and how sustainable is that move to the upside will depend on the other information that accompanies the rate decision. So we're going to get two things of importance. The minutes from the meeting. So essentially this is just a kind of summary of what was discussed, and from that detail we can gauge what is the mood on that committee with regards to their appetite for future action. All right, these minutes, it's more about, you know, how close was the decision? Did they discuss other policy? You know, what about quantitative easing? What about the funding for lending scheme? What about other stuff that they haven't used in the past? All right, so the minutes are going to be important to gauge what's the likelihood of alternative action further down the line. So the minutes are likely going to be dovish, okay, which might cap any upside on sterling in the event there's no hike. Then the other important thing is the vote count. There's 9 people on the committee. We're going to get a score. How many? Let's say they vote to not cut rates. Let's say rates stay unchanged. Well, what's the vote count? Is it 5-4, for example? And by the way, the shadow MPC, that's something that the newspaper City AM run. The shadow MPC, which is a set of 9 people who are considered to be in the know or experienced in these matters. The shadow MPC voted yesterday, and they voted to not cut rates, and the vote count was 5-4. Now, if that happens today, no cut, 5-4, well, actually, that's a dovish hold. So that means, all right, they did not cut rates, but they were the closest they could possibly come to cutting without actually cutting. You only need one person to switch sides in the next 3 weeks for a cut to happen in August. So that would be a dovish hold, which means, sure, knee-jerk reaction, spike higher on sterling because they haven't cut, but then dovish minutes and a dovish hold on the vote count will see sterling stop going up, and we'll start to price in a cut in August with potentially more action, depending on what the minutes say. So I think you might actually get the scenario, sterling spikes higher off no cut, it tops out, I don't know, 134, maybe even 135. Probably, I doubt anything above 135. I think that's going to be your high, and we turn and we then sell off. It is conceivable that sterling finishes down on the day in the event they don't cut rates. As long as the minutes are dovish and as long as the vote count shows a decent amount of people voting for a cut. It could go the other way. They could cut rates, of course. If they cut, well, you could say it's priced in, except that then it's more about the vote count and it's more about the minutes. It's more about, well, what's going to come in August? Do they cut rates today and then really promise more action in August, which is just in 3 weeks, remember? If so, sterling's going to sell off. If it's 9-0, cut rates and a 9-0 vote count, well, that's a dovish cut. That's where the committee is unified, and that sends a real message of intent to markets that this committee are together and they're moving forwards aggressively to support the economy in these times of uncertainty. And you're going to get a sell-off here because it's not about, okay, they've cut, we expect that. It's actually about, right, they're going to do more, and they're going to do more in the near term. You could get a hawkish cut, believe it or not, which would be the scenario where they cut rates as expected, but the vote counts 5-4. So 5 vote for a cut, 4 do not, showing a divided committee, which makes it harder, less certain for more action in the near term. Okay, so there's a lot of variables here, but I think really the key to today into where the value of sterling finishes the session, I think the key is obviously do they cut or not, but then it's actually the vote count and it's the minutes where we're going to find out the intent and likelihood of further action in 3 weeks at the August meeting and further action, let's say, out through the rest of 2016. So this will be the big event for the day. Let me show you the data calendar because there's very little else on it, I'm afraid to say. Let me just show you that. So here's the economic calendar. We've got jobless claims. So other stuff this morning, nothing. So the Bank of England at midday, right? That's the key event. Jobless claims after that, 1:30. We've got some final readings on producer price inflation out of the US at 1:30 also, and then that's it. Okay. In terms of the speakers, we've got some Fed talk. We've had some Fed talk already this week, and really at the moment it's really a sideshow. The Fed have stepped down from being the most important thing, and you've got other central banks stepping up and being in control of global sentiment. That's the Bank of Japan, or indeed the likelihood of fiscal stimulus from Japan. It's obviously Brexit, it's the Bank of England, it's Europe. This is where it's at the moment, which is why Fed speak has really kind of not had much of an impact. So I wouldn't be paying too much attention to these lot. The other thing of note today, JP Morgan earnings. So there's a good article on this in the FT, looking at the 5 things that you should be looking out for here as the banks get ready to deliver news. So we've got JP Morgan today, really the first big earnings release of the season. Tomorrow, Wells Fargo and Citigroup. Next week, we'll get all the other big banks like Bank of America and Goldman's and Morgan Stanley and the like. We'll also get the tech sector starting to come in and deliver earnings. So earnings season really gets up and running properly today. And, we're looking for JP Morgan's views on the fact that ultimately probably rates are going to stay lower for longer. Bad news for banks. What do JP Morgan and the rest of them think about Brexit? How are they going to deal with this? What's the strategy with their London-based European headquarters? What's their outlook for the next 6 months? Obviously, banks have been desperately underperforming in recent times, and it's not like conditions got any better. So we'll see how these earnings come in. JP Morgan at midday. Okay, I'm going to leave you to it. Good luck. Midday really is the big event. Keep things tight until then. Save your ammunition. For now, bullish start on equities. things just calming a little bit now as we now set our sights on the BOE in 3 hours' time.